Hello traders, this is John Kicklighter, Chief Strategist for DailyFX.com. This past 24 hours was marked by volatility and some very noteworthy event risks that generated some incredible movement both from equity markets as well as specifically the euro. Now this is a news-based outcome, particularly for the euro when we saw the release of the ECB rate decision, which, everything being held unchanged, was a big rally point for the euro. All right, this is particularly true of the Euro USD. Now, the question that we have going forward into the coming 24 hours is whether the event risk on the docket for the US can have the same kind of impact on the greenback and potentially even broader risk trends. Now, what data do we have? Of course, we're coming up to non-farm payrolls. Non-farm payrolls, however, is not my primary interest. Now, we watch the non-farm payrolls because it's very good for generating short-term volatility, but most of the market is paying attention to the unemployment rate. All right, this unemployment rate is key to monetary policy. The Fed's stimulus program, the taper as it is currently is the current regime, is dependent upon a continuously deflating unemployment rate. All right, and this is also very important for growth. Now, we need to go into this particular piece of event risk and establish whether this is going to be market moving and what the trading opportunities are for it. All right. So, looking at the US dollar and establishing where we are heading in, you can see that we have made a pretty substantial move here. This is the Dow Jones FXCM Dollar Index. You can see that we've broken this rising trend line going back to essentially September of 2012. All right, a precarious position to be in, no doubt. If we can get a dollar negative outcome from this event risk, it might be an instigation of a very substantial trend. The S&P 500, on the other hand, is at record highs. These two should be moving in opposite directions under traditional risk-on, risk-off themes, but we really haven't had a strong risk-based drive, whether it be positive or negative. However, the employment factors, as it is measured through economic growth forecasts, as well as it's established for the forecast for stimulus and the Fed staying in the game for stimulus, is very important. All right, so we're going to be measuring this on two bases, this employment data. One, is it going to be a driver for risk appetite trends? Is the presumption of strong growth going forward, or maybe a weak employment figure coming out and suggesting that there's some loss of traction? Would that be a risk-on, risk-off theme? And second, would the outcome of this employment data materially change the Fed's bearings? All right. Now, one thing you have to, actually two things you have to be aware of going into this is that we have seen the term weather used more on the markets than we've seen it used on the Weather Channel. All right, there's been a lot of talk about weather and how it has impacted employment, how it has impacted markets and economic activity. All right, what this is kind of an adjustment, an acclimation heading into this event risk, trying to tell markets to not take this data so seriously. All right. In fact, one of the policy officials that we had on the wires earlier today said that we should take the employment statistics for February with a grain of salt because there was a lot of weather-related impact. All right. Whether you believe in that or not, the market's going to start to take that into consideration. Thereby, we should as well. The other thing to take into consideration, all right, this is less of the risk element and more of the stimulus element, is that the Federal Reserve has, as a group, as well as individual members, said consistently, especially the voting members, that they are on a path of tapering, and that is the status quo unless something very substantial changes it. Add to that the fact that they're trying to discount the weather-influenced February, and we are presented with a very interesting mix. All right. So how influential can this data be on the S&P 500 and the US dollar? Well, I've actually calculated that for you, so at least going back to September of 2012. You can see here, this is the light blue line, is the S&P 500's change in the day leading up to non-farm payrolls. The red is the impact after non-farm payrolls, the day after, right? So through Monday the following week. As you can see, it's a pretty consistent back and forth. The day leading into non-farm payrolls, however, happens to be typically a positive experience. Interesting to assess that. Now, when we look at the you don't want to just take it in one day, especially because this is the final trading day of the week. We want to look at this more of a longer period of time. So what about a week forward? This is very interesting. The S&P 500, all right, and if you didn't know it before, the green lines are when there are NFP releases. Once again, the bright blue line is how the S&P 500 had performed in the week leading up to those non-farm payrolls, and the red is how they performed in the week following the non-farm payrolls. Note, one very modest decline, one more moderate decline. Out of 18 non-farm payroll releases, the S&P 500 was up in the week following in 16 of those instances. All right, so this is a certainly positive bias, risk bias. That's exactly what you get from a bull trend, which this has been for not just this period, but it's been more of a bull trend for 5 years. And what does this tell us? It might be a little bit more difficult to turn risk trends around and turn the S&P 500 around on this data, unless the data is exceptionally deviant from what the forecasts are. So it's going to be very, very difficult to turn the S&P 500 off in a span of a week. All right, so that's going to color our expectations. If you're looking for a risk aversion play, let's say, maybe you're looking at it from something like the pound yen or all the yen crosses. Those recently made breaks to the upside. If you're trying to fade those, be cautious because risk trends are a big driver for these pairs. They might not make that risk turn, especially after these kind of breakouts. Right, it's going to be difficult to turn them around. If you want to keep it closer to the U.S. dollar, Aussie USD, all right, this is just starting to attempt an inverse head and shoulders breakout, as you can see here at about 90.80. All right, it's slowly trying to get its way above there. Very much like the inverse head and shoulders pattern we had back here from June to September. But this could actually play out pretty well, but if you have a risk aversion theme, you try to short this, it might not go as far. However, this is more proximate to a level that can play out more as a range. Just make sure you mitigate your expectations, or at least put them in under reasonable assumptions, considering what the typical 1 week changes from risk-based markets. Now, how has the dollar fared with non-farm payrolls? All right, the day afterwards, pretty even dispersion. I'll put these on the real-time news feed. You can search them out there. But you can see in the week going forward that the typical after response from the U.S. dollar is negative. All right. Recently, we've had that nice upswing, and you've had some positive responses here, but we are now engaged in more of a bearish draw. Medium to short term is bearish. So you're going to get a bigger amplitude for data that disappoints the U.S. dollar. How do you disappoint the U.S. dollar from the non-farm payrolls or the unemployment rate? Give us something that backs off of the pressure for QE, all right, or the QE taper. Now, this data itself, here we have the non-farm payrolls, actual versus survey, and of course the surprise between the two of them, that's the red bar. And there have been some pretty hefty surprises in the recent releases. Now, as of right now, the forecast is around 140, 145,000 jobs added. We've had some pretty disappointing figures, particularly from the ADP report and the ISM service sector release. Those were both indicators released on Wednesday. Both of them disappointed. Subsequently, expectations have been downgraded for the non-farm payrolls. All right, so we will watch to see, this is the difference between non-farm payrolls and ADP. We will see if this adjustment, this negative adjustment, is reasonable, and if those expectations have set something of a premium. So if the expectations are negative and that has weighed a little bit on the U.S. dollar, maybe even bolstered the S&P 500 as a risk measure, which this is actually the most difficult assessment here, whether non-farm payrolls better is necessarily good or bad for the S&P 500. This is going to be the more difficult concept here, but for the U.S. dollar, there's definitely negative premium here priced in because of this downgraded growth or this employment forecast. If it's better, that speaks to positive growth, that speaks to continued taper, that speaks to higher market-based yields, and that can give the US dollar a little bit of a boost. Now, when we look at these non-farm payrolls, remember we're not necessarily that interested in non-farm payrolls, at least beyond the short term, better or worse. We're more interested in the unemployment rate, all right? Because that is what the Federal Reserve is looking at. That's what they base their monetary policy decisions on, and the stimulus that they've pumped into the system has been essentially established there because they are looking to help pull down that unemployment rate. Well, as you can see, that stimulus has helped in those regards, or you might be skeptical that they have, but the correlation, or at least the inverse correlation, has played out pretty well. Is there a need to continue to build at this pace, this stimulus, right, and create potential asset bubbles? That's the question we have, right? And we also have to consider that we're not just looking at the unemployment rate, right? Certainly the dual mandate of the Fed is to target an employment or a full level of unemployment. 6.5% is the target that they gave us to start talking about rate hikes. Well, we're already there essentially. And the inflation target at 2% is their equilibrium on price pressures. We're not that far away from it, but then again, we're not really putting a lot of pressure on it. But there is also a talk of looking at the labor markets on a more qualitative approach. So look at figures like the underemployment rate as well, because these are going to be more important towards benchmarking when we'll eventually get to a Fed rate hike. All right, that's what really matters here. The taper is an important first step, but it's a first step to an end game. And that end game is rate hikes, and where the Federal Reserve will be in the spectrum of monetary policy groups that are returning to higher interest rates. Because, like with any trade, we're looking for some significant level of return amongst competing investments, and that higher interest rate is a big component of how attractive an investment looks. All right? Now, as I said, the most difficult to assess outcome here is going to be from risk trends. How are we perceiving a non-farm payrolls or an unemployment rate, as it were, for irrational exuberance or moral hazard? Dallas Fed President Fisher said exactly what many people are concerned about, myself included, that these markets have built themselves to exceptional heights on risky assumptions. They're doing so on the assumption that there is little to no risk that they are taking, because there is a central bank there and stimulus there to prevent them from suffering any kind of meaningful losses. And in doing so, to pursue these yields, these exceptionally small yields, or further capital gains, they are using excessive leverage, or they're using riskier assets. All right? That is a risk situation. And though it seems that even though we have tapered twice, which these two red lines indicate, and the market has held up pretty well through them, the implications of removing that stimulus, all right, in turn will lead the market to assume its own risks. And as it starts to assume its own risks, this is the volatility index upside down, you'll start to see that the volatility index will start to rise, because people will see greater potential for their positions losing money for them. So they go for hedges, they go for something to offset any kind of risk that they have. And we know when we start to see those hedges rise, when we start to see the assumption of risk rise, that there is a subsequent turn in risk-based trends, so something like the S&P 500. Now, this might be looking a little bit too far out for this piece of event risk. All right, complacency might be a little bit too strong still right now, and the appetite for yield too great. But you have to be aware of this medium to long-term concern. This is not just a concern amongst market participants. It's not just a concern amongst analysts and economists. This is a concern amongst central bankers, and we've heard them suggest as much. All right, so always keep this in mind. But whether this is going to be the case for this particular non-farm payrolls release remains to be seen. Nevertheless, be on your toes, because not only are we looking at non-farm payrolls, we look at the continuation or continuing concerns related to situations like the Ukraine, and that can stir risk sentiments as well. There are some very remarkable developments here on these markets, especially in the majors. Euro USD, you can see it broke that multi-year trend line, but I wouldn't be very confident in the follow-through just yet. See how this event risk comes out. Aussie dollar making its way, trying to make its way above a neckline and inverse head and shoulders pattern. All right, the Pound dollar having turned to congestion. This is absolutely an interest rate versus an interest rate currency. The UK and the Bank of England versus the US and the Federal Reserve. This data will help to shift that balance potentially. So this is going to be a great one to measure just how influential the data happens to be. And of course, you can look at the other pairs like dollar yen, all right, which has a very distinct risk exposure, but this puts central banks on a very opposite end of the spectrum. Unlike the pound dollar, the Bank of Japan is looking to expand its stimulus. The Fed is looking to contract it. Kiwi dollar's made a move, all right, just like the Aussie dollar, but a little bit more aggressively. So many opportunities, risk-based, dollar-based, and as long as you follow how this data impacts the market and assess what it means for the risk, what it means for monetary policy expectations for the Fed, you'll be in a good position to potentially trade it. But make sure that it is influential enough and make sure you're in the right bearings with technicals, fundamentals, and market conditions. Good luck trading out there, guys, and we'll do our final strategy video for this week tomorrow.